This is the most relatively smaller asset class in India. 14.1%, that is 93 times in the last 34 years. Your money has grown 93 times in the last 34 years. Now, when there's an upcycle, small caps will always do better than mid and large cap. But now in last 3 years, you saw what happened. All the hotels are going full steam. The prices have gone up by 2, 3, 4 times, right? To me, this is the safest thing in the world from long-term point of view, because if these 50 companies goes bust, then your entire portfolio will come zero. People have forgot that equities can go down sharply. It is giving us a false sense of security that every year will make 15, 20, 25, 30% return. It doesn't work like this. And will not do anything for the next 2 years. That is when your real patience will be tested. Okay, so this is a very, very important slide. So if your money was in savings account 1 lakh, after 16 years, your savings account has become 2 lakhs. FDs became 4.5 lakhs. But if you're the shareholders of these banks, like ICICI Bank 47 times, HDFC 48, IndusInd 62, Axis 200 times, Kotak 780 times. In the long term, look at the comparison between savings account, FDs, and as a basket of owners of these banks, right? That's the point we all miss, most of us. And now we discuss equity as an asset class, okay? And this is the most relatively smaller asset class in India. Most people are not aware about how equity works, okay? How equity markets work, and what are Sensex, what is Nifty. So Nifty and Sensex is nothing but they are basket of 50 largest companies of India. So it's a well diversified 50 companies index reflecting overall market condition. So these are the companies which are there part of Nifty. Okay, they keep on changing, from time to time. So this is like you have Infosys, Tata, Reliance, HDFC Bank, and stuff like that, right? But remember, these basket also keeps changing, and when you invest in Nifty over a period of time, you will earn the average of the 50 companies returns which this basket gives, right? And to me, this is one of the safest investment in the world. As I say, a typical Indian is confident to invest in a single property but afraid to invest in a portfolio of top 50 businesses. So this is a portfolio of top 50 businesses. To me, this is the safest thing in the world from long-term point of view, because if these 50 companies goes bust, then your entire portfolio will become zero. So while we are willing to put 50 lakhs, 1 crore in a single property, we are not confident to put even 5 lakh rupees in a basket like Nifty or Sensex, right? This is quite surprising, and that is why financial literacy has to improve in our country. What has been the track record of Nifty for the last many years? So as you can see here, Indian equity is the long-term journey, and Nifty is nothing but Indian equities. 14.1%, that is 93 times in the last 34 years. Your money has grown 93 times in the last 34 years. Look at the journey from 1990, started with let's say I think 1,000 points, and today we are at around 25,000 points. Okay. Sorry, it was I think it was 100 points actually. So 93 times your money has grown, right? And the CAGR has been 14%. But remember one thing, this is not one straight line. While you're looking like this is a straight line, there have been a lot of periods when it moved nowhere, then suddenly it went up, then again it was flat for good, many years, then again it went up. So it has been highly volatile, but you're not able to see this, capture this, because it's a long journey. But there have been periods when it has fallen by 40-50%, and then it has gone up again very fast. This was COVID. Like now look at this, this was just COVID. It went down by 40%, but now it is looking quite small because we're looking at a 20-25 year period. So but in the long term, if the economy does good, all these 50 companies do good, index has to go up. Always remember this. In the short term, there is no guarantee what will happen, but in the long term, it will go up, right? So this is Indian equities, and there is always a reason to sell equities. Hardly I see when I go around people always wanting to sell, because there are always some other events that keep coming, right? You saw in 2020 COVID was there, Israel Hamas war, Russia Ukraine crisis, BJP came out with lower majority, and now US elections are there. So every time you have some or other big news that is influencing you to sell because you think these things will impact equities and you're not confident about it. In spite of all these events for the last many years, the return has been 14%. This is the power, because all these events has nothing to do with the basket of these 50 companies in the long term, right? In the short term, of course, everything gets disrupted, but companies find ways and means. Like COVID happened, all the hotels got shut down, right? They made losses for those 1-2 periods, but now in last 3 years, you saw what happened. All the hotels are going full steam. The prices have gone up by 4 times, right? There's no vacancy. There are no kind of vacancies in the rooms there. So they go through cycles, but in the longer term, if the trend is up, you will make money. So always remember that in the long term, equities will give you high returns. Within equities, you have like three subsects like small cap equities, mid cap, and large cap. The yellow line is a small cap, the red is mid cap, and the blue line is large cap, right? Now, one thing you have to understand that all these have cycles of their own, but every 5, 6, 7 years, they all, when there is an end of market cycle, when there is a downturn, when everybody is lying down, I mean, when everybody's giving you bad returns, they all converge. So in April 9, all converge. Then again April 13, 14, all converge. And then somewhere around 2020, all converge. But now when there's an up cycle, small caps will always do better than mid and large cap. When there's a big down cycle, small caps might do worse. And it all come back to mean. That is the beauty of markets. They're all cyclical. They will always revert to mean. So today, the more the divergence, the more this becomes riskier. Okay, this can't go on forever. Whether it is Indian markets, US market, it all has to converge. So always remember this. This is quite important. But small caps are supposed to be more volatile than mid caps and large caps, right? Remember this, very important.
You can achieve your luxury car, dream home, retirement, and all your other financial goals without taking a loan. How? Through mutual fund investing. Hi, I'm Gajendra Kothari, founder of Etika Wealth Private Limited, and I've been investing in the mutual funds for the past 15 years. I'm here on Upsurge.club with my mutual fund course to help you achieve financial freedom. In this course, I will teach you everything about mutual funds, how they work, their different types, how to analyze the mutual fund scheme, and how to select the best fund for yourself. You'll also learn how to build your mutual fund portfolio through examples. So, enroll in this free course today and start your wealth creation journey with mutual funds.
Now, this is the returns of Indian equities for a long period. Sensex started with 100 points, and today we are at 80,000 points. When you have invested over only 1 year period, rolling return for a 1 year period, your time horizon was 1 year. So 68% of the time you were lucky. Okay, 68% of the time you got lucky. Now, when you change this time frame to 3 years, 83% of the time you got positive returns, which means the more time you increase, right, the return keeps increasing. So 5-year period, on a 5-year period, 93% of the time you were positive on a 5-year period, and 10-year period, 97% of the time you were positive, which means this was the only period, I think, somewhere in March 2002, which means you have invested in 1992 and your period ended in March 2002. That is the only period after holding for 10 years you got negative return out of investment in equities. So for a 20-year period, if you see, there's been no negative returns. And the worst return has been 7%, which was, I think, in the year 2012-13, and then 9%. But on an average, you've got around 14-15% return when you're invested for 20, which means the more you come on the right hand side or the longer time frame, you are going to get much better returns and you will hardly ever see negative returns. Though there is no guarantee in equities, as I said, your money can go up and down, but the longer the time frame, the more stable your returns will be. Okay, so this is very important for you to understand. This I've summarized in a very beautiful chart again from Funds India. It says 83% of the times Indian equities have given more than 10% returns over a 7-year period. Okay, 83% of the times Indian equities have given more than 10% returns over a 7-year period. So this is a 7-year period. Why 7-year period we have taken? Because market cycles usually are 7-year period. You have seen a good cycle, you have seen a bad cycle. So it's all average out. So greater than FDs. Suppose if FDs gives 7%, how many times equities have beaten FDs over a 7-year period? 98% of the time it is beaten. 98% of the time, right? And over a 10% return, 83% of the time it is delivered more than 10% return. That is the beauty of equities over a long period. Okay, this is very, very interesting to understand. Of course, when you want to get more than 15% return over a 7-year period, 38% of the time it is given more than 15% return. But you should not be really looking at this. This is not very easy to beat. 15% is a huge, massive return, right? But I think 7, 10, 12, somewhere in this range is a reasonable expectation from equities. Okay, this has also happened in the US. This has happened in other developed countries, and that's why I see it should happen in India as well. But the one thing that you have to understand, that equity markets also goes through declines every year. Because it can give you much higher returns, it also goes through declines. Every year equity markets witnesses at least 10 to 20% decline, which are temporary in nature, almost every year since inception. Okay, so this is the kind of decline from the top it made in a particular year to the bottom in that particular year, right? So what was the difference? The top difference between top and bottom was 47%. Okay, in 2008 the difference was 60%. Markets came down by 60%. In 2020 in COVID it came down by 30%. But particularly in the last 10-12 years, the average has been around 21%. But we have seen most of these declines less than the average, and that makes me worry. Okay, because it is the nature of the markets to be volatile. Last 10 years we have seen hardly any volatility. In fact, in 2023 it went down by 7%. In 2024, of course, now in September and October, November, it has slightly more declined, maybe 8-9%, but this is nothing. The average itself has been around 21%. The more volatile the equity markets become, the more opportunities to create wealth. The less volatile, it is going to be, more difficult to create wealth. So always remember this. This is very important, and that is in particularly post-COVID, because we've not seen much decline. People have forgot that equities can go down sharply. It is giving us a false sense of security that every year will make 15, 20, 25, 30% return. It doesn't work like this. Okay, there will be periods when it will go down by 30%, 25, 40%, and will not do anything for the next 2 years. That is when your real patience will be tested. Okay, so this is a very, very important slide. Only 4 out of the last 44 calendar years had intra-year declines less than 10%. Right? Only 4 out of 44 years. And guys, whenever this happens, that the intra-year decline is less than 10%, like what we saw in 2023, 2017, I would suggest be cautious, right? Hopefully in the next 1, 2, 3 years, you are going to see a large decline because it has to be cyclical. Okay? So this is what I have experienced this from my last 20 years of being in markets. Okay. Now, but the good news is that all these declines are temporary. The upside is permanent. So the red ones are declines, green is upside. Every time there was a bad news, like in 91-93 Harshad Mehta scam, it declined by 54%. In 96, 97, political uncertainty declined by 41%. So every time there has been a decline, it is followed by a green line, red line, green line, but the trend is always up. Okay, this was COVID, and now you saw what happened post COVID. So don't get worried by what's happening right now. Things, events, huge events like elections, war, drought, famine, these things will keep coming, but in the long term the march will always be up. Okay, that is the beauty of equities. So you have to understand what Warren Buffett says, that unless you can watch your stock holding or equity holding or your equity mutual fund holding decline by 50% without becoming panic stricken, you should not be in the stock market. Which means if you are investing in equities, you should be comfortable in seeing your values of equity funds, stocks, direct stocks, PMS can go down by 20, 30, 40 and even 50% sometimes. though rare, but it can happen. If you are vulnerable to this, you shouldn't be in equities. Okay, it's a very important thing. The other thing which you have to understand is that equity markets move like a pendulum. Okay, so we know how pendulum works. It doesn't remain at the center. It will keep on sliding between left and right. Now, my belief is that equity will never give you average returns. It will sometimes give you high returns, sometimes give you low returns. 90% of the time, 90% of the time between here and there, you should do nothing. Do nothing. Even if suppose, this is the average. Today, suppose markets are here, right? We are here. If you are a long-term investor, right? If you're a long-term buy and hold investor, my belief is 90% of the time you should do nothing. There are two ways. Every time this goes here, you can do rebalancing and bring back to center. When I say rebalancing between equity, debt, gold and everything, bring back to center. The other way is if you're a buy and hold investor and if you don't want to really rebalance as such, then 90% of the time you should do nothing. Only in 10% of the time, which is like 5% of the time here and 5% of the time here, when markets are at the extremes, extreme low points, extreme high points, is when you should sell that asset class and go into other asset class. This can happen with equities, this can happen with gold, this can happen with any other asset class. This is my belief, this is what I do. Why I don't touch this? Because I want to capture the good upside and I also want to capture good downside. But sometimes it's very difficult to predict when markets are here. Very, very difficult to predict, right? But sometimes if I get a sense of feeling that, okay, now my investments have given huge returns in the last 1, 3, 5 years, and I don't see this sustainable, because you have to compare this with your long-term returns of that asset class. If there's a huge divergence, I think you should take your profits from the table and either invest in some other asset class which has not worked, or wait, keep in short-term, deposits, debt funds, etc. Like in COVID, I felt market was here, and that's why I invested a lot of money in COVID. I've not seen COVID-like situation right now here, so I'm waiting. But when markets again fall back to these levels, I'll start putting a lot of money again. And when markets come here, I'll start selling a lot of money. Okay, selling, which means booking a lot of profits. So again, this is my philosophy. Each one can have their own, but equity markets or any other asset class move like this in pendulum. And this is a classic way to see. This has been the average returns of Sensex. So most of the times it is closer to this, but it will never be exactly this. So 13, 3 kind of thing. Between 30 to 60% returns few times, and above 60% returns very few times. One thing you remember, if markets have given above 60% returns, very likely that in the next 1-2 years, it is going to give a major negative return, okay, or flattish returns. Be very careful with this. And when markets have given something like this, okay, again, it's very likely that next year or next another year, it is going to bounce back in a style. So it is like that pendulum. The more pendulum swings towards left side or right side, the more the contraction will happen, right? So the thing that I want to share is, when you have these extreme events like these or these, you should be little cautious. You should be cautious on, or opportunistic on the either side, right? This is how markets behave. Okay, this is again very, very interesting. So as you can see here, like why I'm showing this, these are all banks or lending institutions. HDFC, now it has been merged. So HDFC Bank, Kotak Mahindra Bank, SBI, Bajaj Finance, ICICI, Axis. Now a lot of people are happy giving the money in fixed deposits to these banks, 7%, 6%. And the reason they tell me is safe. This is safe, and my money will grow at 6-7%, and I'm quite kind of happy. But what they don't realize is right now that we are lending our money to the bank, we are depositors, right? What if you were owners of these banks? Then what happens? So let's say you were an owner of, so today Axis Bank gives you 7-8%. If you're the owner, right, since inception, your return would have been around 28% per annum. Okay, if you've given your money to SBI Bank as an owner, you may have earned 19%. From long term, since inception, 27%, Bajaj Finance, ICICI Bank 22%, right? You can name any good quality bank. If you are giving your money on deposit to them, they earn, they actually very happy. As a shareholder of these banks, I'm very happy if you come and give us your money, because we'll deploy your money at high rate. We'll give you 7-8%. We'll deploy your money at 9, 10, 11% return. The margin that we get out of this, right, makes us this kind of returns. That is how business owners makes the maximum amount of money in the long term. So most people, while they're comfortable putting deposits in these banks, they're not comfortable owning these banks as shareholders. And that's the irony, because they think this is risky. FDs are not risky. Okay. So I hope this would have been quite important. And again, this is a little dated slide, presented by Kotak Mutual Fund many years back, 99 to 2015. So if your money was in savings account 1 lakh, after 16 years, your savings account has become 2 lakhs. FDs became 4.5 lakhs. But if you're the shareholders of these banks, like ICICI Bank 47 times, HDFC 48, IndusInd 62, Axis 200 times, Kotak 780 times. I mean, all these things can change, can reverse, but in the long term, look at the comparison between savings account, FDs, and as a basket of owners of these banks, right? That's the point we all miss, most of us. So that is why equities, and I can go on and go on with other brands as well. From Maruti to Mercedes. Maruti has been a fabulous story over a long period. Many people are comfortable buying Maruti car. I'm not saying that you should not buy Maruti car, but if you think Maruti is one of the best companies in India, and there's a lot of waiting time, a lot of people want to buy Marutis, you see all around you people are buying this, then why don't invest also in that same company? Okay. And Peter Lynch had this great funda that you should invest in the companies which you consume on a day-to-day basis. That's the best way to find out, right? So if you would have owned this 6 years, may the share price of Maruti would have given you so much returns that you could have also afforded a Mercedes-Benz car along with it, right? After 6 years. This is just a metaphor to prove the point that how stock prices can make you wealthy. From economy to luxury, this is Eicher Motors, right? So in 14 years, not just buying a motorcycle, if you would have invested the same amount in the stock of Eicher Motors, you could have owned a Rolls-Royce car also. And I can go on and on like this. Sun Pharma, we consume their medicines. We use Godrej hair dyeing products, Parachute oil, cigarette from ITC. Look at the kind of wealth these companies have created: 114 times, 90 times, 66 times, 19 times. But the problem is that we all consume these things, but we are not owners of these companies, right? And that is why we have missed out on this. Again, you can never become rich by renting out your time. This news item I saw, Dr. Naresh Trian, one of the finest cardiac surgeon in the country, if he was just a doctor and would have charged anything for a surgery, 2 lakh, 5 lakh, 10 lakh per hour, okay, or per surgery, how many surgeries he can do in a day and how long he can do, he could have never become multi-millionaire, billionaire, okay? But because he owns hospital like Medanta in Delhi and other places, and it is a listed entity, it's listed on the stock market, and if the prices of these companies go up, he's one of the largest shareholder, lifts his share, chief and surgeon Naresh Trihan to billionaire list. He was billionaire, exactly a year back. It crossed $1 billion or worth 8,400 crores. He could have never earned this money in surgeries. Okay. And that is why I tell people that in the long term, equities can create the best asset class. Your businesses can give you the highest amount of returns, and no other asset class can match this kind of thing. Again, my friend Vishal Khandelwal made this beautiful chart explaining why equities, even to a housewife, to children, right? This is a family anywhere in the world, anywhere in India, you see, and what kind of items we consume. So as you can see, the wall, Asian Paints, Berger, Kansai, Nerolac. We use Hitachi, Blue Star, Volta's air conditioner, right? The children uses Marico oil. This is Nestle, ITC, noodles. Everywhere you see in the house, there's a brand. Everywhere. And you have to just observe and then invest in those companies. Most times you'll go right, because what you are thinking is what many other people are also thinking. And if all of us are consumers of those companies, we can also make money as shareholders at the same time, right? So equities need not has to be complicated. It can be as simple as this. What you own, what you own is what you own as a consumer, you might want to own as a investor also.